Hello everyone, welcome to another edition of Under the Macroscope, Skybound Capital's regular podcast series in slightly different surroundings this time. We're testing something a little bit new. Since the advent of the podcast series, we've been conducting them via Zoom or Teams or some other online system. And today we're just in an environment together, which is actually really quite pleasant, with Carl and Xander Engelhard, two members of Skybound Capital's research team. And today we are talking about commodities. And commodities have been a really hot talking point of late, most notably because of the ongoing conflict in Ukraine, the Russian invasion of Ukraine, and the extensive knock-on effect that has had in so many aspects of the global economy, not least the supply of oil and other valuable commodities. And commodity prices have been affected, supply has been dramatically affected in many different parts of the world. So we're going to get into a discussion around commodities, commodity pricing, how commodities can and perhaps should form part of an investment portfolio. But before we get into detail, Xander, I have to ask you, for the purposes of this podcast, how do we define a commodity?
I mean, for the purposes of the podcast, we'll be talking about commodities in their traditional sense. So that'll be essentially your raw materials, your primary agricultural goods, and so on. And examples of this would be like, for instance, oil. We're looking at grains, industrial metals, precious metals, and so on.
So let's take that a step further, because can one generalize then around commodities? I mean, how related are market forces on one commodity over another? Is it possible to put them in one basket and just refer to commodities as an asset class?
I mean, that's a good question. So in terms of generalizing amongst commodities, both yes and no. So all commodities essentially have their own idiosyncratic risks and cause-effect relationships that essentially govern them, right? However, in their various sectors, so we have a few primary ones such as energy, industrial metals, grains, precious metals, softs, for instance, which is like your coffee and your sugar and that kind of thing. In that sense, they're by and large impacted by the same economic forces, and therefore we can generalize them in those different buckets.
Carl, given those definitions and the fact that we can put commodities into different silos, why are commodity markets so volatile at the moment?
It's a good question, Matt. So to answer that question, there are multiple factors at play which are contributing to the current price volatility we're seeing in the commodity space. And to provide our listeners with some general perspective, we have very tight commodity markets leading into the COVID-19 pandemic. And in order to contain the spread of the virus, we all know that governments across the globe initiated various forms of lockdown measures, which ultimately resulted in economic activity to decline considerably, as well as the demand for commodities in general, right? And this was also reflected by the sharp price declines we saw in 2020. I'm not sure if any of you guys can remember, but the price of WTI crude oil in April 2020 was actually negative $36 per barrel, which is in stark contrast to what we're seeing today. And in order for these governments to jumpstart their economies effectively, they basically initiated unprecedented stimulus packages, which basically turbocharged demand. But what's important for everyone to note is that although that the stimulus measures turbocharged demand, it didn't necessarily increase the supply side's capabilities to produce, right? So we kind of have an environment today where we have demand significantly outpacing supply. In addition to all of this, there has been a general shift in the investment industry towards ESG and impact investing, which has led to a divestment trend in high CO2 emitting sectors such as energy, mining, and the like. And this has resulted in underinvestment in those particular supply chains, making them very vulnerable to any form of supply side shock like what we've seen today. So those are the main factors kind of contributing to volatility in the commodity space we've seen today.
So let's just expand on the environment as we see it now, and you're saying there was already, pre the war in Ukraine, big pressure on supply. So stimulus in demand, shortage of supply, that's only been exacerbated now in the last 6 weeks.
Yeah, well, to answer your question in a roundabout way, when we speak about tight commodity markets, there's maybe one, maybe two of the primary sectors or markets that are exhibiting these tight characteristics. Now, the difference that we have today is that all three primary sectors, so that's industrial metals, as well as energy, as well as grain, are exhibiting these tight characteristics. And this is obviously, as you said, exacerbated inflationary fears. And the Russian invasion of Ukraine has been a massive supply side shock to the system, effectively putting a quarter of the global wheat supply at risk, which has its own knock-on effects. In addition to this, if the NATO allies follow through with their planned sanctions against Russia, this would effectively take about 12 to 13% of global crude, as well as about 25% of natural gas off the market for these nations. So to answer your question more directly, the environment that we're seeing now is one that has increasingly vulnerable supply chains, as well as in terms of price movement, one that is very, very volatile.
And is it temporary because of the war zone that we're seeing in Ukraine, or can you see a way out of it in the near to medium term?
I'll take that one quickly, Carl. I mean, in short, we don't see a short-term solution in order to bring more supply online. And that's due to a multitude of factors, but I mean, one of the main ones is just there's a considerable lag period in terms of basically getting new supply online. So for example, if we had to look at the agricultural sector, okay, if we look at an oversimplified example, farmers, for instance, can now respond to the shortage in supply by planting new crops. Okay, they'll only be able to harvest these new crops in the next harvest season, so you get a lag period. Now this lag period is even more pronounced in the mining sector, for example, where it can take anywhere between 5 and 15 years to get a new mine operational and obviously producing industrial metals, for example. Another very important factor for everyone just to keep in mind is we're all aware that the EU have this almost over-dependence on Russia for natural gas, where Russia attribute roughly 40% of the EU's natural gas consumption. Now the EU is desperately trying to basically reduce this dependence on Russia, but what we need to understand is natural gas is an incredibly difficult commodity to transport. It requires a lot of infrastructure and so on, whether it be transported through natural gas pipelines or whether it gets transported through as in the likes of liquid natural gas and so on. And in order to basically rejig this infrastructure, it will require a lot of investment and a lot of time. Okay? Carl mentioned earlier that there's been this general divestment trend from these high CO2 emitting sectors. So in terms of due to obviously ESG and so on, so that investment hasn't necessarily been there. Okay. Ironically, the produce from these high CO2 emitting sectors, such as the industrial metals and so on, are actually needed for the transition into the green economy as well. Okay. The last point I just want to mention in terms of more of like a long-term view is we can't ignore the impact of climate change. Now, extreme weather events have shown to be quite a kind of significant supply chain shock in the past. And I mean, if you just look at the US and you look at the 20 years from 1980 to 2000, there were 91 extreme weather events. That's roughly 4 extreme weather events per year, right? If we look at the subsequent 2 decades, so from 2001 to 2021, there were 232 extreme weather events. That's 11 extreme weather events per year, over 150% increase from the 2 decades prior. And what's important to note is the majority of that 232 extreme weather events took place in the second decade of that 20-year period. So I mean, taking into account that we obviously have the lag period to get new supply online, okay, we have this dynamic in the EU and the basically dependence on Russia for energy, as well as the longer term impacts of climate change. We can likely anticipate that this current tight market will persist for a longer period of time, and that tight markets will persist more frequently in the future, and when they do take place, also persist for longer periods of time than what we've seen in the past.
Dare we call it a perfect storm scenario? I mean, and you add to that another regular topic on this podcast in the last 12 to 18 months, that of inflation. We've seen global inflation ramping up. So let's talk about commodities and commodity markets as they pertain to inflation. Is there any protection there?
I mean, in terms of an allocation to a portfolio, in short, yes. The general 60-40 portfolio, as Colin and I have spoken about in the podcast in the past, lacks the assets that can perform well in an inflationary environment. And we've seen that today. with both equities and bonds coming down significantly so far this year. So what's just another factor that's important to note is different commodities can protect your portfolio against different ways inflation can transpire. So whether it be monetary inflation, which comes from the printing of money and the devaluing of currency, precious metals have been a very good hedge against that, in particular gold. Okay. If we then look at the kind of inflation that's taking place right now, which is this cost push demand pull dynamic, which is essentially a demand and supply imbalance, industrial commodities have shown to be a very good hedge against that kind of inflation. That would be your energy, for instance, and your industrial metals.
Without imparting advice, because we don't impart direct advice on this podcast series, but what would be a sound investment strategy around commodities?
Yeah, well, if we consider what Zander just said now, that different commodities can protect investors' portfolios against different ways inflation can transpire, as well as the fact that each commodity is exposed to its own idiosyncratic risks and catalysts, probably the most sensible approach would be to have a diversified allocation to commodities in one's portfolio. So, for example, if we just looked at what happened in 2020, right, you had gold performing extremely well, and that was due to its ability to hedge against monetary inflation, as we saw central banks printing large sums of money in order to stimulate their economies. In addition, industrial metals also performed very well in 2020, and that was supported by China's ability to emerge from the early stages of the pandemic sooner than Western nations. And during the same year, oil faced its own idiosyncratic risk and faced a torrid time where it had its rapid price declines, and that was basically due to a demand shock as a result of lockdown measures, where there was a substantial decline in transportation such as airfare, or air travel. So just considering those factors, a diversified allocation to the space, due to how dynamic this asset class is probably most sensible.
Now, I'm lucky enough to know the extent of the research that you two do, and the way you analyze equities, commodities, various asset classes. And I know you would never be advocates for trying to time a market, but is there, without generalizing too much, a good time to be looking at commodities as an asset class?
I'll take this one quickly, Carl. As you mentioned, timing markets is a dangerous game, and a game that most people get wrong, essentially. But what we do find is when it comes to commodities, they do play by a slightly different rule book than equities and bonds. For instance, in terms of when you'd want to have an allocation to commodities, if you wanted to have it as a hedge in your portfolio, it would be number one, when commodity markets are tight or tightening, and number two would basically be when inflation is present or rising at a fast rate, essentially. And those are two things we actually can measure. The reason is that in this kind of environment, these commodity markets and basically just global supply chains are very vulnerable to supply side shocks, and they can have a very big impact. And having an allocation to, as Carl mentioned, a diversified basket of commodities in this environment could make your portfolio more robust, basically to weather the storm, essentially.
But is it a case of maybe saying that cycles in this sector are somewhat easier to predict based on some of the underlying macro components?
Essentially, yes. One can measure how tight the commodity markets are. Also, what's interesting to note, I was watching an interview, a Bridgewater interview actually, where they were basically discussing, because we answered one of the questions earlier today, will supply basically come online, to kind of meet this excess demand. However, what's the difference between today and the previous commodity super cycle? And the commodity super cycle is basically an environment where there's been increasing demand in the commodity space, whether it's a particular commodity or basket, is that there's no planned supply to come online. There's no new mines waiting to tap into excess reserves, etc. So this is kind of the let's say challenge that the space faces today. So yeah, basically we see that the tightness of this commodity market would be to remain for quite a prolonged period of time.
Challenge is a key word because there seem to be challenges all over the place. And I suppose one of the lessons coming out of this discussion is the need to be versatile and not scared of remodeling an investment portfolio, because some of the macro conditions at play here are changing almost on a daily basis.
Definitely. I couldn't actually agree more with that, yeah.
So stay versatile, stay open to suggestion, and in the commodity space, it's something that one's got to keep a constant eye on.
I think, I don't know if we just should quickly touch on, I mean, there is different ways, obviously, investors can gain exposure to commodity markets. I mean, for instance, they can go through the likes of an ETF or an index tracking fund.
Yeah.
And what's important to note is that essentially the performance you'd get from that ETF or index tracking fund won't necessarily track the spot index, for example. And that's essentially because the return you would get on a commodity ETF is made up of two components. You have a spot price as well as a roll yield. And that roll yield is generally a detractor to portfolios when commodity markets are in their long-term kind of trend. However, in tight commodity markets, that roll yield can actually act as a kind of a benefit to your portfolio as well. So it's just important to also look at the intricacies to how those funds operate as well, if they can optimize this component of the portfolio also.
Fascinating. As always, it's been really interesting to have this chat, and certainly the commodity space is something that Carl and Xander and the research team are spending a lot of time on, analyzing, researching, and staying abreast of all the latest developments. And as always, we say that comprehensive research is at the heart of making good investment decisions. We would welcome any feedback, any questions that you might have. You can use the email address or website address that comes up during the course of the podcast to get in touch. If you'd like to direct any specific questions to Carl and Xander on this topic, you can do so. Or feel free to give us your comments, your views. Those are always welcome as well. All past editions of Under the Macroscope are available on Apple, Spotify, the Google Podcast platform for Android, or indeed on our website at www.skyboundcapital.com. And we'd always welcome you to get in touch with some suggested topics of conversation for the podcast. We ourselves are versatile and open to suggestions, so get those into us, and until next time on Under the Macroscope, cheerio.